Imagine earning money simply by holding a specific investment. That's the basic idea behind carry trades, a popular strategy among seasoned traders. Carry trades involve borrowing money in a low interest rate currency and investing it in a higher interest rate currency. This difference in interest rates, known as the carry, is where the potential profit lies. This seemingly simple strategy can be quite lucrative, but it also carries inherent risks. Understanding the underlying principles and potential pitfalls is crucial for success. This guide will break down carry trades, explaining how they work, the potential benefits, and the risks involved. Whether you're a novice or an expert trader, this guide will provide valuable insights to help you navigate the world of carry trades. By the end, you'll have a better understanding of how carry trades work and how to maximize your potential for profit while mitigating the inherent risks. So, if you're ready to learn more about this fascinating trading strategy, let's dive in and explore the world of carry trades together. At its core, a carry trade involves borrowing money in a currency with a low interest rate. You then take that borrowed money and invest it in a currency with a higher interest rate. The difference between these two interest rates is your carry, representing your potential profit. Think of it like borrowing money at a 2% interest rate and lending it out at a 5% interest rate. The 3% difference is your potential gain. Imagine borrowing 10,000 Japanese yen at a 0.5% interest rate. You then convert this amount to US dollars and invest it in a US bond yielding 2.5%. The difference of 2% is your potential profit, assuming the exchange rate between the yen and the dollar remains stable. To initiate a carry trade, you need access to a trading platform that allows you to trade currencies. Many online brokerage platforms offer this service. It's crucial to choose a reputable and regulated broker to ensure the safety of your funds. Remember, while the concept is straightforward, carry trades are not without risk. Diversification and risk management are crucial aspects of successful carry trading. Experienced traders often employ more sophisticated techniques to maximize returns and manage risk. One such strategy involves leveraging, which amplifies both potential profits and losses. By borrowing more money than you initially invest, you can increase your returns, but you also increase your risk exposure. Another advanced strategy involves using forward contracts to lock in exchange rates. This helps mitigate the risk of adverse currency fluctuations. Expert traders also utilize technical analysis to identify optimal entry and exit points. By studying chart patterns and indicators, they can anticipate market movements and make more informed trading decisions. Diversification is a key risk management strategy that can help protect against large losses. Section 4. Real-world examples and case studies of carry trades. One classic example involves borrowing Japanese yen at low interest rates and investing in higher-yielding assets like Australian or New Zealand dollars. This trade was popular for many years due to the consistently low interest rates in Japan and the higher rates in these other countries. Another example involves borrowing US dollars at low interest rates and investing in emerging market currencies with higher interest rates. A real-world case study involves the Turkish lira crisis in 2018. Many investors had borrowed in low-yielding currencies and invested in Turkish lira-denominated assets to take advantage of high interest rates. However, a sharp decline in the lira's value led to significant losses for those involved in these carry trades. These examples highlight the potential rewards and risks of carry trades. Section 5. Avoiding common pitfalls in carry trading. One common mistake is failing to adequately assess the risk of exchange rate fluctuations. Many novice traders focus solely on the interest rate differential, without considering the potential impact of currency movements. A sudden depreciation in the investment currency can quickly wipe out any gains from the interest rate differential. Another pitfall is over-leveraging. While leverage can amplify profits, it can also magnify losses. Ignoring economic and political factors is another common mistake. Exchange rates are influenced by a variety of factors, including economic growth, inflation, political stability, and global events. Diversifying across multiple currency pairs can help mitigate risk and protect against large losses.